An important observation for the global economy is that when social cohesion weakens, markets react, even in developed countries. This isn't just about the details of a single incident, but about the systemic effects of unrest on market performance. Research from the International Monetary Fund, IMF, suggests that major unrest events can be followed by a meaningful drag on GDP. One 2021 IMF paper noted that 6 quarters after a major unrest event, GDP was on average about 1 percentage point lower than it would have been otherwise. The key question is not if social unrest affects the economy, but how the impact propagates through the system. This analysis will break down how deep social divisions can become a critical macroeconomic risk that redraws the map for investors, corporations, and governments. Flashpoints of social tension are often indicators of deeper institutional stress. When events escalate from a local crisis to a broader conflict involving different levels of government, it signals significant pressure on the institutions that underpin social stability. The immediate consequences can include protests and business closures. However, these are not just social or political events, they are also economic data points. Disruptions to daily life affect workforce participation and commerce, while political infighting creates an environment of uncertainty that can hinder business and investment. For many years, political risk was often viewed as a concern primarily for emerging markets. Recent events in developed nations indicate that this risk is now a domestic factor in the world's largest economies. Economists are now actively developing models to forecast economic output based on measures of institutional instability. The social fabric of a nation is becoming a more quantifiable, market-moving variable. What we are witnessing is the evolution of social unrest from a series of domestic issues into a systemic macroeconomic risk factor. A country experiencing significant internal division may face challenges in executing effective international policy, see a decline in consumer confidence, and find its appeal as a safe haven for capital diminished. This new reality has profound implications for how capital moves around the globe. A localized protest can send ripples through the global financial system through 5 distinct channels. First, investor confidence and risk premium. Unrest increases uncertainty about a country's future policies and stability. Investors, in turn, demand a higher return for taking on this increased risk, which raises borrowing costs for the nation's government and corporations. Second, supply chain disruptions. Political instability can shut down critical infrastructure like ports, highways, and rail lines. Labor strikes or blockades can halt manufacturing and logistics, leading to production stoppages and increased costs. Third, consumer behavior and economic contraction. Public anxiety about the future often leads households to reduce discretionary spending and delay major purchases. This pullback in consumer demand can slow economic growth or even contribute to a recession. Fourth, policy paralysis and unpredictability. A government preoccupied with domestic crises has diminished capacity for long-term economic planning and predictable foreign policy. This creates an unstable environment for multinational corporations, making long-term strategic investment more difficult. Finally, currency volatility. Social unrest can trigger capital flight as investors sell off local assets and currency. A sharp depreciation makes imports more expensive, which can fuel inflation and further destabilize the economy. History provides numerous examples of how social instability can reshape economies. The Arab Spring. Beginning in late 2010, protests spread across the Middle East and North Africa. The primary market mechanism was the fear of supply disruption in energy markets. As unrest reached Libya, Brent crude oil prices surged from around $90 to nearly $130 a barrel in a matter of months. The events also led to a sharp decline in foreign direct investment in the region, with the most affected nations seeing combined economic costs estimated at over $55 billion. France's Gilets jaunes, yellow vests. In late 2018, Protests that began over a fuel tax expanded into a wider movement. The key impacts were on consumer behavior and policy response. Road blockades severely disrupted the retail and restaurant sectors during the crucial holiday season. The movement ultimately prompted the government to announce a multi-billion euro package of economic concessions, directly linking social unrest to fiscal policy. Chile's 2019 social outburst. A protest over a subway fare increase in October 2019 evolved into a national movement against inequality. The economic consequences included supply chain and infrastructure damage, with Santiago's subway system alone suffering hundreds of millions of dollars in damages. Deseasonalized GDP fell in the fourth quarter of 2019, but the most significant outcome was a major policy response. The protests led directly to a process to draft a new constitution. This convergence of social and economic risk changes everything. The idea of a risk-free asset is being reevaluated. Even the debt of the world's most powerful economies is now viewed through a new lens, one of institutional and social stability. Central banks and global investors have to price that risk in. For corporations, a good business plan is no longer enough. Now, they need a geopolitical one, even for their domestic operations. They have to ask, are our supply chains resilient to a sudden protest? How will political polarization affect our customers? This creates a dangerous feedback loop. Unrest causes economic pain. That pain, job losses, rising prices, growing inequality, fuels more public anger. The cycle can repeat, with each turn further damaging the economy and breeding more instability. Investor takeaway. Key data to watch. For investors, the price of security is no longer just about military defense or cybersecurity. It's about domestic stability. The premium is on cohesion. Tracking that risk means watching new signals. Sovereign debt spreads, a direct measure of a country's perceived risk. Currency volatility, an early sign of capital taking flight. Consumer confidence surveys, the pulse of the domestic economy. Shipping and logistics data, an early warning for supply chain breaks. Policy uncertainty indices, a way to quantify political chaos. The link between social cohesion and economic stability is no longer a footnote, it's a headline. The map of the global economy is being redrawn, not just by interest rates and inflation, but by the divisions running through societies. The price of everything must now account for the stability of the system itself. But this battle for stability is also moving into a new domain. Control over a nation's digital and financial infrastructure is becoming the next critical choke point, a place where the flow of capital and information can be weaponized in an instant.